Okay, let's dive right into this explainer. If you've ever looked at the financial markets and felt like it's all just a noisy, chaotic collection of random price movements, well, you're missing the hidden architecture underneath it all. Today, we're going to map out that interconnected web of global assets. And speaking as a senior financial analyst, I'm going to walk you through exactly how to leverage those market correlations to your advantage. So, are you trading assets in a vacuum? It's a really serious question, and honestly, you need to ask yourself this before placing any other trade. A massive pitfall I see constantly at the retail level is folks staring at just one single chart in complete isolation. They get laser focused on it and completely ignore everything else happening in the world. But at the institutional level, we see the entire board of moving pieces. We know that a ripple in one corner of the global economy is going to create a wave in another. Look, if you're trading a single asset without looking at the macro picture, you are literally flying blind. And that brings us to our foundational concept for today: market correlation. This is essentially the core understanding of how different global assets influence each other. Honestly, this is the absolute bedrock of the material we're covering. The market is basically a living ecosystem. Assets do not move independently. They are actively pushing and pulling on one another every single second of the trading day. Grasping this concept, that's exactly what separates reactive participants from proactive strategic analysts. Now, the primary structural link we monitor is the dynamic relationship between the US dollar index, the DXY, and major assets like gold, along with other major forex pairs. So, how do we actually map this out step by step on daily charts? First, you want to identify the macro trend on the DXY daily chart. Second, overlay the gold or forex pair chart to spot any divergences. And third, look for key support and resistance breaks that confirm the correlation. Because the dollar is the world's reserve currency, its underlying strength or weakness acts as the gravitational pull for these other major assets. Specifically, we're looking at an inverse relationship here. Think of it literally like a giant financial seesaw. When the DXY moves aggressively in one direction, gold and major forex pairs tend to move inversely, right? So a stronger dollar pushes the price of gold down simply because it takes fewer of those stronger dollars to buy the same ounce of gold. It's a mirror image. But listen, here is an absolutely crucial risk management tip for you. During volatile market swings, do not double expose yourself. If you're long on the DXY and short on gold, you're essentially taking the exact same trade twice. You've got to size your positions accordingly so a sudden macro shock doesn't wipe out both trades simultaneously. This matrix is basically your baseline cheat sheet for institutional-level market awareness. It summarizes exactly how these specific assets push and pull against one another. You've got the heavy hitters, the DXY directly opposed to gold and major forex in an inverse relationship, while oil prices and the Canadian dollar share a direct affecting relationship. Now let's talk specific entry points. When the DXY hits a major resistance level and prints a daily bearish reversal candle, that right there is your trigger to look for long entry points on gold and Euro USD. The very second the DXY pulls back, capital flows directly into those inverse assets. Moving into Section 1, Commodities and Currencies, specifically the oil and CAD link. You absolutely must track global oil prices to monitor their effect on the Canadian dollar. Canada is a massive global exporter of crude oil. When oil prices surge, the Canadian economy historically benefits, which in turn strengthens the CAD. So if you're out there trading USD/CAD without keeping a really close eye on West Texas Intermediate or Brent crude, you are missing half the story. So how do we actually put all this to work for CFD trades at the desk? Well, before executing anything, you need to run through a daily index checklist. Number 1, check the overnight DXY close. Number 2, identify any upcoming macro news catalysts. And number 3, note the current support and resistance levels on major commodities. Knowing about the seesaw of the DXY and the commodity link of the CAD is great theory, sure, but applying it to your actual CFD execution is where the profit lies. Here's the exact sequence to gain that edge. Step 1, track the US dollar index. That is your baseline pulse of the overall market. Step 2, anticipate the inverse movement in gold and forex. And step 3, apply this as a leading indicator for your CFD positions. You see, you don't just react to the gold chart. You use the DXY's momentum to forecast what gold is about to do next. That is the fundamental difference between leveraging a leading indicator and suffering from a lagging reaction. To wrap things up, I want to leave you with this exact rule from our material. Use the DXY as a leading indicator for your CFD trades. These global assets are always talking to each other. So the question really isn't whether the market is giving you signals. The question is, are you finally going to start listening before you place your next trade? Keep this correlation strategy front and center, and I'll catch you in our next explainer.